All right. Thank you everyone for coming. I hope you're all doing well. Welcome to this evening's technical workshop on technical interview basics. My name is Amber Ray. I'm a sophomore at Columbia. I'm a VP of Mission, Vision, and Values in the LDP at the Columbia chapter, and I'm the technical workshops team lead, hence why I'm here tonight. Just as a note, we would love to see your faces as it does give the presenters a lot of energy, but if that's not a possibility for you at this time for whatever reason, totally understand. And now I'll pass it over to Nick and Chad, the leads for this evening's workshop.
Thanks, Amber. So to introduce myself first, I'm Nick Fabbroni. I'm a junior studying finance and computing and data science at NYU Stern. Currently a private equity intern at Burgal Sagemount. I've been there for almost a year now, 11 months. And my free time, I enjoy skiing, biking, museums, and whatever doesn't involve Chad.
Hi everyone, my name's Chad. I'm also a junior at NYU Stern, and I'm studying finance and econometrics with a minor in social entrepreneurship. I'm currently working as a venture capital intern for American Family Ventures. Started with them in June. And I'm also a javelin thrower for the NYU varsity track and field team.
Chad, they're going to come in one at a time. It's the slide effect.
All right, word. So today we'll be talking about technical interviews. And to start off, we'll give you an intro of what technicals actually are, what their purpose is, then go over accounting, valuation, DCF, M&A and LBO, brain teasers, and we'll go over some example questions at the end where you all can participate. And then hopefully we'll have a little bit of time for a Q&A at the end.
Awesome. So to begin, oh shit, this is your slide. Go for it.
Yeah, so what is a technical interview and why is it a thing? So a technical interview will be interviews on questions that are related to whatever job you're applying to. The technicals that we'll be going over today will be most applicable to investment banking and capital markets roles. And there's basically served two purposes. The first is vetting that you are competent in ideas that are going to be relevant to when you actually get on the job. And second, which is honestly probably more why they exist, is just so that the interviewers know that you actually care about this job, that you're interested in whatever you're applying for and you're taking it seriously. So you've taken the time to learn all your technicals and you're going to come in there, be prepared. And that's going to show how much you actually care about getting this job, showing your work ethic. How to approach studying. So today will be an hour session, which is barely going to give you anything, honestly. We're going to go over the very basics and hopefully lay groundwork for you to just get a general idea. So you're at least like conversational in the next few weeks, but we are also going to send out all the guides that we have after this. So you'll have access to those, and how I would approach that is you kind of want to start, I'd say at least 6 months out from when you're actually going to be recruiting and interviewing. You're going to want to start studying, and it would be helpful to join a recruiting study group if you could. They have them on a lot of college campuses. And then you want to just be able to periodically go back and study them on a specific cadence. That way, whenever an interview is to pop up, you won't have to cram for it. So if you do know the answer to a question, you want to make sure that you're answering succinctly, taking your time, getting the answer right. And you also want to make sure that you're not being scripted whatsoever. Because like you'll see in the guides, they have textbook answers and they'll know if you're just reciting these or if you actually have a fundamental understanding. So you want to be able to show that you do. And how to answer if you do not know the answer to the question. First, I'd say there's like two ways to approach it. One is if you have half of an understanding on what they're talking about, I would give all the understanding you have up front. And the second option would be to say something along the lines I'm not 100% familiar with this concept, but if you provide a little more context, I'd like to see if I could reason my way through it, and that'll show them your ability to think on your feet and reason through. And I wouldn't use that more than probably once in an interview. We can move on to the next slide.
Awesome. So accounting, this is the basis of finance. If you don't know how important this is, your interviews will reveal this to you, that you need to know accounting, or the basis of accounting, for everything, not just accounting questions, but in terms of, if people ask, how does free cash flow get calculated in your DCF? What are the revenue and expense synergies in an M&A deal? You need to know how these three financial statements work and how they interact with each other. We begin with the income statement. There's probably a refresher for those of you who with a little financial experience. It lists revenue, expenses, taxes, and after-tax profit at the bottom. To be on the income statement, items have to meet two main requirements. They have to correspond to the period shown. So the income statement is a periodic summary of basically your revenues and your cost of goods sold and periodic expenses. So this will be either quarterly or monthly or yearly. And the income statement is not going to reflect the purchase of a building that's going to take 20 years to depreciate. It's going to have separate charges like depreciation, amortization, to account for the yearly depreciation or loss in value of those long-term assets. So for an item to be on the income statement, like for example, cost of goods sold is tied directly to the sale of a good in that period. The items need to meet that criteria, and they need to be tax deductible or affected by taxes. Because we multiply by 1 minus the tax rate to get net income at the bottom of the income statement. For example, debt principal is not affected by taxes and does not meet those requirements. That's why it's not on the income statement. We also have two more statements that you might be less familiar with. First, the cash flow statement has 3 sections: cash flow from operations, cash flow from investing, and cash flow from financing. This also, like the income statement, tracks a periodic change in cash. It serves 2 purposes: to show changes in non-cash items from the income statement, and to see if there's additional cash inflows or outflows not reflected on the income statement, like those capital expenditures for that 20-year building that could have been financed through some means of cash, and you need to account for it in a separate, just a separate statement. You also have the balance sheet, which is just very simply the company's assets and how it acquired those assets, liabilities or debts, plus equity. And A equals L plus E, as you know from accounting. Some basic line items on all of these, just to go through. Income statement, you start with revenue, then cost of goods sold, down to operating expenses. Items like depreciation, amortization, stock-based compensation are in the income statement. Interest payments, gains and losses on sales of investments or property, plants, and equipment. I can't say that right now. Write-downs, other income and expenses, and EBITDA. You might see EBITDA on an income statement. This is earnings before interest, taxes, depreciation, and amortization. It's representation of the company's operating profits, their operating income. That is capital structure independent. And what that basically means is that it's excluding interest payments, which are tied to the debt that the company has outstanding, and depreciation, amortization, 2 accounts that don't really reflect the true value of the company's operations, because you can depreciate assets and amortize assets different ways. So EBITDA is just what a lot of financial institutions and professionals use to compare companies on a pretty, I guess, similar basis. You don't have to take your capital structure into account. Cash flow statement, you have cash flow from operations that have those non-cash charges like depreciation from the income statement added back, as well as accounts payable, prepaid expenses. Cash flow from investing has the purchase and sale of long-term investments, CapEx, I'm not even going to say it. sales and proceeds of PP&E, and cash flow from financing has the repaying and issuance of debt, share buybacks, and dividends. You can think about those as cash flow from investing and financing are usually the ones that get mixed up. If the company is using a financing activity like repaying, issuing debt, and issuing dividends, it's different from making a material investment in a long-term asset that's going to bring you value over time, or from making a capital expense to buy a new plant, for example. It's more for short-term or temporary funding needs. So the balance sheet, you guys know from accounting probably, current assets, long-term assets. Current assets are inventory, accounts receivable. Long-term assets, PP&E, goodwill, for example. Current liabilities like deferred revenue, accounts payable. Long-term liabilities like long-term debt, and equity like common stock. Retained earnings, which is your net income from the income statement, factors into retained earnings. And treasury stock, which are stock buybacks. There's a lot to know in all of these financial statements. This is why you need to study this a lot. And this is why I would suggest that you spend a majority of your time getting the accounting down, reading through that guide a couple times, and making sure your foundation is solid. Employers will ask you how they link together. You need to notice that net income links from the bottom of the income statement to the top of the cash flow statement. What non-cash items from the income statement you add back on the cash flow statement. At the end of the cash flow statement, the net change in cash from the bottom links to the top of next period's balance sheet. Those are important connections that are going to help you when you have problems like, how does a $10 depreciation affect three financial statements? How does a decrease in inventory that was bought for $10 and sold for $20 affect the three financial statements? They're trying to see if you understand the real business effects of any action that this company takes on its finances, because not all of them are clear. And you're going to need to discern these when you're actually looking through financial statements and determining the health of a company. So, parting advice with accounting, we're going to go through the depreciation example with everybody later. I know that was a lot, but familiarize yourself with these statements and spend the most time, I think, here in the beginning. Get your core foundation. It'll help you understand everything else much easier. Chad?
Yeah, before we move on, I really just want to emphasize what Nick said about accounting. It is 100% the most boring part of studying technicals. However, it is 100% the most important. And that's how you're going to start out, and you're going to be like, this really sucks. This is so stupid. But if you don't get that down, you're not going to be able to get anything else down. So really spend the time up front learning your accounting left, right, and backwards. We can move on to valuation now. So essentially there are two types of value of a company. There is enterprise value and equity value. So equity value, as it sounds, is the total value of equity of a company. So that is going to be all the outstanding shares of a company multiplied by the share price at the time, reflecting 100% ownership of the company and how much that is worth. So enterprise value, on the other hand, can be thought of as how much it would cost to actually acquire that company. So you're going to start with equity value. And then if you think about it, if a company has debt, when you acquire them, you're going to have to pay off that debt. In most M&A transactions, that's a requirement. And if not, you're going to have to pay off that debt eventually. So you're going to add in that debt because you're going to have to pay that in addition to the equity value that you're paying. And if a company has large cash on hand, you're going to be ultimately saving on this transaction because you're paying X and you're getting back Y. So you can just subtract that out. So in the most simplest form, enterprise value equals equity value plus debt minus cash. And then understanding how we actually value a company. So there are three valuation methods and two types of valuation. The first type is a relative valuation. So that is comparing a company to something else and then understanding its valuation based on a host of other companies that are similar. So the first example of this would be a public comp. So let's say you have a pharmaceutical business in the US of $1 billion market cap. You will look at other companies that are similar, so also US pharmaceutical companies with a similar market cap or doing similar numbers in revenue. And you will use those. Obviously, you can't use one because the more you have, the more accurate the price will be. That's just like statistics. And then the other form is precedent transactions, which is extremely similar. You're looking at similar companies. However, you're looking at how much these companies were acquired for previously. So looking at transactions where the acquired company is similar to yours, and then looking at the price of that M&A deal and seeing how much you are worth in terms of that. And what's super important, sorry, lost my train of thought. What's super important with these is that you're not going to be valuing them based on the average, like actual value of the firm. That wouldn't make sense because each business is so unique that even if you're a pharmaceutical company in the same industry at like a similar earnings, every business is so unique that you can't just use that to go off of. So what you do is you use the multiple that's implied by the valuation of these other companies. So the two most common types of multiples that you'll be using are the operating multiple and the equity multiple. Equity multiple, I'm sure you're familiar with. That's price over earnings, also known as a PE multiple. But what's even more common in terms of like investment banking specifically is the operating multiple, which is EV over EBITDA. So that's enterprise value over EBITDA, which Nick was explaining before. And why they use that is EBITDA is a good measure of the actual operating income of a business. It's like the most close that you can get. So that's basically how relative valuation works. So the other type of valuation is called intrinsic valuation. And if we move on to the next slide. So before I get into DCFs, I want to mention that we are going to have a whole nother separate technical workshop on DCF. And for that reason, I'm not going to get into the nitty gritty and just give a really brief overview. So DCF has two components, and the first is the future cash flows of that business. And the second is the terminal value of the business. So the reason why you can't just use future cash flows forever and strictly that is that no matter how good your assumptions are, no matter how stable a company is, after 5 to 10 years, depending on how well you can predict the business, you're not actually going to be able to predict cash flows past 10 years. It's just really unlikely. You never know what is going to happen. So at 10 years, we use something called the terminal value, which is essentially the worst of this company at that end of that 10 years. And that gets added to the value of your future cash flows. And that gives you your total value from the DCF. And to calculate the terminal value, there are two methods. One is called the Gordon growth method, which I'm not going to get into the actual equation because, like I said, we'll be doing another workshop on this specifically. But it's essentially assuming that the company is growing into perpetuity forever at a rate that is under GDP. And then this will eventually just tail off to zero because the discount rate is going to be larger than the growth rate. And then on the topic of discount rates, we can't just add up those two numbers, terminal value and the future cash flows, because as you know, it's like one of the most basic principles of finance is money today is worth more than money tomorrow. So we need to discount that. And how exactly we discount that is using something called the WACC, or the weighted average cost of capital. And basically what the WACC does is it takes the cost of equity for the firm and it takes the cost of debt for the firm and then weights that and averages it based on the company's capital structure. So if a company was financed with 50% debt, 50% equity, the cost of equity and the cost of debt would be equally represented to give the WACC. And so some factors that impact a DCF mostly are going to be growth. Growth is something huge because even a slight or medium change in growth rate will really change the the future cash flows at around year 10 and ultimately the terminal value, just because of compounding. Additionally, some other things that can affect DCF is capital structure, like I said, because that's going to change your discount rate. And when your discount rate changes, your present value is going to dramatically change. So the pros and cons to using a DCF, first off, there's specific companies that would be better to use a DCF on than others. For example, if a company has extremely stable cash flows and it's very predictable, it has a long history. So think something like Coca-Cola, it would be easy to project those cash flows with pretty safe assumptions because you have so much historical data and they are so stable. So your DCF would probably be pretty accurate and therefore pretty valuable. However, if you have a startup or any company that's young, is growing quickly, let's take Clover Health, for example, who just yesterday announced they will be going public. If someone tried to do analysis on that company for the acquisition of that SPAC, they would not be able to get a good number because their growth assumptions are going to be so off. Like when you're growing at such a high rate, like doubling year over year, there's no way to get an actual prediction of your free cash flows and how those will grow into the future. So it really depends on the type of business, if a DCF is going to be applicable or not. But one of the big pros is that it is completely intrinsic type of valuation method. So you don't have to compare it to anything else. So if a market's super overpriced in a certain industry and multiples are insane, it won't be affected by that. And you'll get a more true sense of what the company is fundamentally worth. There is a caveat to this. As I mentioned, terminal value can be used, can be calculated via relative valuation at the end. That's why the Gordon growth method is typically preferred. So you get 100% intrinsic valuation on that. Before we move on, there's a question. Oh yeah, so we will we'll get to that. Yeah, thank you for the question. I'll hand it over to Nick for M&A and LBOs.
Sure. So you apply to a firm, you apply to their M&A group. Well, what is a merger and what is an acquisition? A merger is just the consolidation of two or more companies of roughly the same size, and an acquisition is an above 51% stake or takeover of another company where the controlling firm has more discretion on how to determine the company's size and the company operations. So why would you acquire another company in the first place? It comes down to IRR. If companies don't believe that internal investment is enough money, or rather is enough, if they'll have to use an increasing amount of money to gain returns internally, and they could gain a more effective business operation from purchasing another company outright, they would much rather do that. And some financial reasons are first, EPS accretion and dilution. For those who aren't familiar, this is just basically, if you see EPS accrete, it's a mathematical way of representing the earnings to price ratio of a company being greater than the earnings to price ratio of the company that's acquiring them. And this mathematically will raise your EPS as you'll be more effective on earnings per share. So EPS accretion is a big one, and it rationalizes a lot of mergers and acquisitions because shareholders, when EPS goes up, the stock is viewed as healthier, and the share price is most likely to go up. Could be for consolidation like T-Mobile and Sprint, though that was a merger of the third and fourth largest players in the national telecommunications space, looking to compete with those top two players in the industry. Geography, I worked with a company who had a client base in America, but was solely looking to acquire a company in the UK just to gain its customers in the UK. You have to do this with large maturity software companies. It's harder and harder to generate good returns on sales and marketing spend for new customers. You would much rather just take the existing customers of another company, and you would be better off for it. The smaller company might have faster growth, and that's a trend like Chad was mentioning. Growth affects the company's returns very much, and smaller companies have larger growth potentials. Or a company might be undervalued that you're looking to acquire. You think that this company isn't being represented, either some macro event like coronavirus depreciated its value, and you want to snipe it up at the right time for cheap. There's fuzzy reasons too. I think the main one that the guides mention is intellectual property, and this could be the case of some software company, large tech company rather, acquiring a very small software company, and you're like, why? They probably have the engineers to code that. It's solely for the employees, solely for the couple of people at that startup that this firm feels could value their business, and they become PMs of Twitter and Facebook and whatnot. So there's a bunch of reasons, but a rationalization that a lot of people use, and the main driver of these decisions are the synergies. How can you, yeah, Chad did we had a meme originally of the SpongeBob rainbow, and that's kind of what it is. Because these aren't always scientific. Revenue and expense synergies are kind of the two main ones I want you to be concerned with. Revenue synergies are, and you assume an increased price point for a product after merging with another company or additional products being sold. Expense synergies could be a reduction in labor force. You realize you don't need the sales and marketing team at that company you're acquiring. It's a nice way to say you just fire a crap ton of people and save on employee expenses, or it could be building consolidation, other expense synergies like that, where you don't need as much property as you currently have. There are many deals rationalized that cite billions of dollars in synergies that have absolutely no grounding because they haven't happened yet. But they're used to rationalize deals, and a company arguing that it can affect the other company's operations in order to make the investment profitable might be enough to push that transaction over the line. You guys will also have to realize, not so much for interviews, that a lot of the work investment bankers do is getting across the finish line, and it's not always pretty, and you have to make the best rationalization that you can, sometimes for deals that you might intuitively know don't make a ton of sense. Briefly on LBOs, I don't know if anybody has PE experience in here, but if you have private equity experience going into an IB interview, they will ask you. They can ask you. In my Guggenheim interview this summer, I got 15 LBO questions rattled off in a row to me. I don't know if I think that's the most absurd amount I've ever heard. But you'll definitely get some, and you should be prepared for it. Basically, a PE firm uses leverage to acquire a company, generates free cash flows to pay down interest payments, and sells a company after 5 to 7 years at a higher multiple than what they bought it for, realizes their IRR, which is the compounded annual effective interest rate, by using less equity up front. None of you understood what that means or has a grasp on it because you shouldn't, because it's really a weird thing to know unless you're in private equity. So a simple example of an LBO is buying a house. If I'm going to buy a $500,000 house, I can't do it now and probably not for a while with complete equity, with $500K in cash. I'm going to have to take out a mortgage, which is leverage. And that's the PE company taking on a significant amount of debt, usually 60 to 80%, in order to finance that transaction. So I take out a mortgage on the house, but I'm a savvy homeowner. I didn't use a lot of cash up front. My debt payments are scheduled. I know them. So I attempt to generate more rental income or more free cash flows through this property by not living there in order to cover my interest payments. You see, like in a private equity LBO, they will use the free cash flows generated from this mature, predictable company to cover the interest payments of the debt that they use to purchase them with. Then in about 5 to 7 years, I'll sell my house for hopefully more than I bought it for, and realize that gain there of both selling it for more than I bought it for and that rental income that I'm getting, that was surplus of the interest expenses that were going out. That's a very high level. Please don't study the LBO guide that we give you unless you have PE experience. I really doubt that you'll get asked about it if you don't. But if you do have PE experience, a question I've gotten is why IB over PE. And they also tend to ask me intricacies about LBOs, despite me not having a ton of experience with them personally. So be prepared. but mostly focus on M&A consequences, especially when you're looking through deals to talk about.
So before we hop into the brain teasers, just to note something that Nick just mentioned, the easy way out here obviously is to not have PE experience and do VC instead because it's superior anyway. Just wanted that plug out there.
In VC, Chad just looks at the prettiest logos and that's the companies he invests in. So if you want a little less complicated analysis, go that way.
And just to jump in there, something that you brought up is if you have PE experience, they will ask you PE stuff. So I feel like it's a good thing to mention that whatever you have on your resume is pretty much fair game for them to ask you questions about. So if you don't feel comfortable with accounting, don't put accounting as your skill because they will take that opportunity to drill into you about those topics. Correct me if I'm wrong, Nick and Chad.
No, you're completely right, but also you can't be a deer in headlights. Chad was talking about earlier how to answer a question when you don't know the answer. That's a situation. If you don't have any PE experience and they ask you about an LBO, you can say, hey, I don't have personal experience with anything related to financial sponsors, but I do know X, Y, and Z. Just a general premise about the topic. They'd rather appreciate your effort than you nailing the question exactly right. So yeah. Amber's completely right. Don't advertise what you don't want, though.
Yeah, if you're doing anything, especially an internship, if it was like even a little bit, like if it's something, if you did a sales and trading internship, they might ask for a stock pitch. If you're doing VC, they might ask for a startup that you're excited about and why. So really just any experience that you have in addition to everything that's applicable to investment banking, which will be all the guides that we will be sending at the end of this and what we covered today. Make sure you're able to talk at least decent about anything that you've worked in previously.
Okay. So now the fun part. So brain teasers. They're real and you get asked sometimes how to do some stuff that you probably didn't expect after you're going through all those accounting, valuation, financial metrics. They'll pull a fast one on you just to see if you were reciting that information or if you're really there, present in the room, interviewing with them. They just want to see how you think. It's important here to note process over answer. I bet that none of you know how many pennies can fit inside the Empire State Building. And if you do, please get a hobby. That's not something that you're expected to know going in the interview, but it's the process. It's how you think through it. You have to ask questions or make assumptions actively. For that example, you would be thinking out loud. Well, penny's about, let's see, an inch in diameter, and the floor is 30 feet by 30 feet. The building's however many feet high. You can make assumptions about, this theoretical scenario and make up your own answer that, that's how you get credit for it. You won't get credit for just saying, oh, a crap ton, you have to show some, not a crazy amount of I guess, mathematical prowess if it's computational. And it doesn't need to be completely right. Don't be looking for the right answer and we'll show you why. Chad, if you want to just shoot about computational square.
Yeah, so computational teasers will be something has some aspect of like math. And it might not even be math, but just like numbers that will have to like tease your critical thinking out. So does anyone want to volunteer for a brain teaser? Okay, well, you coming here has been you volunteering, so I will select someone randomly. No, I'm not actually going to do that. But if anyone does want to volunteer, I'll take you. If not, me and Nick can run through one ourselves.
We already know the answers, though, so it's a lot less fun.
Yeah, exactly.
Throw me in the ring, boys.
All right, sounds good. So this is a fairly common brain teaser. So you have a 5-gallon bucket and you have a 3-gallon bucket. And these do not have any incremental measures on it. You only know that a full bucket is 5 gallons and a full bucket is 3 gallons. And you have a hose and you can use as much water as you want. How do you figure with complete certainty to get 4 gallons?
You're gonna help me out here, right?
I mean, just you can use your reasoning, and it can be conversational.
Okay. Buckets.
Do you know when you have half a bucket of water?
No, you don't know any incremental measurements besides the complete top.
Can I help?
Yeah,
Yes, Amber.
Please.
Can I give some reasoning and see if it's correct?
yeah, for sure.
Okay, so you have the 5-gallon bucket and you fill up the 3-gallon bucket and you pour it in the 5-gallon bucket. And then you leave that in there and then you fill up the 3-gallon bucket again and pour it into the 5-gallon bucket. So you have 1 gallon left in the 3-gallon bucket. And then you dump out the 5-gallon bucket and you pour the 1 gallon into the 5-gallon bucket. And then you fill up the 3-gallon bucket and pour it in. And then you have 4.
Yeah, that's
Is that right?
That's the right answer. Yep.
Okay.
There's a couple ways to do it, but that's probably the most efficient way.
Sorry, I know I'm the host, but
That was awesome. No, that was perfect. JC, can I get you for this last one?
Yeah, sure, man.
All right. I have a question for you. Just tell me the right answer. Is the egg yolk white or are the egg yolk white? Which is correct?
Well, there's only one egg yolk in an egg, so it would be is.
All right. Congratulations. You're wrong. Egg yolks are yellow.
Oh, shit.
Yeah.
You got me, man.
That's a real 2020 Guggenheim investment banking interview question. And I got the bucket one in a super day about 3-4 weeks ago. So these really come up and you really got to be ready for them. The answers aren't always what you expect, but again, it's your process. It's your thinking about it. That last one is shot and I don't expect anybody to ever get that question. And I hope nobody ever has to ask that again. It's evil, it's cruel. But the bucket one is a very good example of how fast can you think on your feet? Are you going to get frozen if we tell you this bit of information or this assignment's due in an hour? That's their purpose. I don't know if they exactly nail it, but it's what it is. Don't study them too much, but be conscious that they're there. That's my suggestion. Okay. So we've reached the example part of our presentation. This is going to require your participation as well. We're going to lead it mostly, so you don't have to worry about anything that you don't know. But we just want to show you an example of what are 5 questions we've actually received and how we thought about answering them. What's our thought process? I think it's helpful to not just know how to study the guides, but when you get up to bat, how to swing. So first, walk me through a $10 depreciation. So $10 in depreciation will first occur on one of the 3 financial statements. Does anybody have a guess of which one it is?
Yeah, just feel free to shout the answers out.
Balance sheet.
Wrong.
Income statement?
Yes. It does occur on the income statement, usually under operating income. It's depreciation can sometimes appear as its own separate line item or in cost of goods sold as well. But the main thing that you need to know is that depreciation is that periodic, like I was talking about, expense that accounts for the decrease in value of a long-term asset. That's why it shows up, because every year you're taking off a certain amount of value from that asset. So a $10 depreciation charge will affect pre-tax income by $10. Pre-tax income will be down $10. Can anybody tell me how I get to net income after that?
Multiply by 1 minus the tax rate.
Right. And that's pretty important. In the guides, it'll say, I think 40%, and that was based on a 35% corporate tax rate. Now the corporate tax rate's at about 21%. So in an interview, it would show that you're, I guess, with the times hip. If you use a 25% tax rate for your problems, I'm not going to because I'm lazy. So times 1 minus the tax rate, 40% for the tax rate. That means your net income will be down by $6 in the period. What's going to happen next? What do I do with that negative $6 in net income to reflect the fact that depreciation was not an actual cash expense that I paid? I go to another financial statement. I'll give you a hint. There's 2 left.
Goes to the top of the cash flow statement.
Right. And so depreciation, the full $10, this is important. So we have negative $6 in net income, depreciation times 1 minus the tax rate. The full $10 of depreciation gets added back on the cash flow statement because we didn't spend any money in cash. We didn't give any cash towards this charge. We gave cash towards the cost of goods sold. That was the inventory that we used to buy the goods that were sold in our revenue. We didn't actually pay anything towards the depreciation charge. It's more of just it's a non-cash expense. That's what it's called. So on the cash flow statement, you start with negative $6 in net income, add back that $10 in depreciation, the cash flow for operations. And at the bottom of your cash flow statement, because we don't want to double count, we're not adding anything else back. We already did. At the bottom of our cash flow statement, our net cash for the period is up $4. This might sound counterintuitive, but as you'll go through the guide, you'll understand why a little more. That net change in cash for the period, that $4, where does that go next? There's one financial statement left. Probably goes there. Okay. It goes to the balance sheet. So that money, the $4 positive for net change in cash, goes to the links to the next period, the balance sheet. Cash is an asset. It's going to be up by $4. And I'm not even saying it. PP&E, which is where your depreciation expense is going to decrease the value of equipment that you have. That is going to go down by 10. So your net change in assets is minus 6 for the period. That reflects an equal negative $6 from retained earnings decrease on the balance sheet. Retained earnings is just your net income minus dividends for the period. It's pretty intuitive. Your net income is what you're gaining. Your dividends are what you're paying out to shareholders, and your retained earnings are retained, what you keep. So negative $6 in retained earnings matches with the negative $6 in your assets and the balance sheet balances. So it reflects that you save on taxes. The employers will ask you basically to understand your competency. Do you see how I moved from income statement down the income statement to the top of the cash flow statement, down, and then to the balance sheet? That's the progression that I suggest you do. And they want to see that you can account for a lot of changing and multivariable factors at once. Practice in front of your dog, your friends, your mirror, on how those answers sound. The more concise that you can get the answer while still retaining all the information, the better off you'll be in your interview. Next.
I could do this one. So I want everyone to just like unmute, or if they have any answers, feel free to talk. So how would you value an apple tree?
Maybe by the price of the apples it can produce.
Okay, yep, that's correct. We'll dive deep into each one a bit more. Any other ways?
Can do a comparative valuation by seeing how much like similar apple trees are valued.
Yep, and the other one's like pretty similar too. It's just going to like a history of how much apple trees are selling for. So with the first one, how much each apple is worth on the tree and adding that up. So you're going to have the assumption of how many apples that tree will produce, what the lifespan of that tree is, and then how much each apple is worth. So if you couldn't tell already, we're talking about DCFs. So you're projecting the cash flows from the tree, and then using all your assumptions to determine how far into the future, how many apples each year, and how much the price of apples will either grow or decline going forward. And the other one, looking at price of other apple trees, you can look at this, and if we're trying to keep consistent with how this would actually work, you would look at how much this apple tree is being valued compared to how much it's producing in apples, or how many apples it is producing, if you want to use the amount of apples as the EBITDA, and the actual value as the EV in this. So you take an average of all similar apple trees in the area and how much those are valued at, and then get the implied multiple of EV over EBITDA, and then apply that to your own EBITDA, multiplying that to get your EV eventually. And the same thing with precedent transactions, just looking at how much these have sold for previously, and doing the same thing, getting an average of the multiples implied with those prices, and then applying that to your own EBITDA. One thing to note that I forgot to note in our valuation section was, which of the three forms, precedent transaction, public comps, and DCF, do you think will produce the highest valuation? If anyone has any ideas.
Precedent transactions, because M&A deals are valued at a premium.
Yeah, that's right. And that's because most companies aren't actively seeking to sell themselves. So in order to acquire a majority stake or 100% of the company, they're going to need to pay a premium on top of whatever their real value is. So yeah, that covers the apple tree. We can move on.
Awesome. So calculation time. Everybody have a pen, paper? This isn't like your algebra textbooks. This will be pretty easy. So a quick summary on what enterprise value is, aka the answer to this problem, is equity value, which is just number of shares times outstanding share price, plus preferred equity, preferred stock rather, plus debt, plus minority interest, minus cash and cash equivalents. So let's say Chad's Bananas has 100 shares outstanding, priced at $100 each. 100 shares outstanding at $100 each. Chad's Bananas also has $1,000 in debt, $500 of non-controlling interests, and $2,000 in cash and short-term investments. What is Chad's Bananas enterprise value? So I can go through the details again for everybody. So Chad's Bananas has 100 shares outstanding, each priced at $100. He also has $1,000 in debt, $500 in non-controlling interests, and $2,000 of cash and short-term investments. What is his enterprise value? If anybody has an answer or needs to know one more piece of the equation that they might not have taken down correctly, please ask. And I'll go through the calculation after.
What was his debt again?
His debt is $1,000.
Maybe what we can do is when you have come up with an answer, put the green check mark in the participants tab just so we have a sense of when to move forward.
Pamela?
Oh wait, did you say cash is 200 or 200,000?
Sorry, cash is 2,000.
Oh,
Is it a 11,000?
Okay. Can you tell me how you got to that?
Well, enterprise value is shares outstanding minus debt plus cash, right?
Okay. So, well, all right. So you started with your what? Equity value, which was what? How'd you calculate equity value to start?
I took total shares outstanding multiplied by share price.
Okay. So that's 100 times 100. So 10K equity value. Then
Subtracted,
what?
subtracted by debt.
Okay. Why did you subtract that? If you're acquiring another company, and they have $1,000 in debt, what does that mean for you as the acquirer? Do you have to assume that debt, or can you forgive it?
Yeah, you're right. So you add debt,
Right, right,
and then you subtract cash.
right. Okay. And so that brings us to $9,000. Also, I mentioned $500 of non-controlling interests. Those minority interests, you also have to assume that you'd have to pay over for. So the correct answer is 9,500 in enterprise value. Again, like Chad was saying earlier, you have to think of when I'm acquiring this company, what will I have to pay for and what will I receive? If you're buying them and they have $2,000 in cash, that's what you get. Those are assets to you. You don't have to pay for that. Or effectively, on the net basis, even if you pay for it, you're going to get it. Debt, however, you now assume the obligation to pay, and so your enterprise value will increase. The company's not getting more valuable; it's just worth more. So, very quick, I think we're going to run through these next two. I think you guys can ask some questions.
Yeah, so this next one you'll be able to get if you paid really close attention to Nick's part, or if you're just here and you know your technicals and just want to emasculate other people in the question section. So why can't we use equity value over EBITDA for our valuation multiple? I mean, functionally we can, but why would it not make sense?
equity value is only for holders, while EBITDA is available to all equity holders and debt holders.
Yeah, so in another way of like putting that is that, as Nick mentioned before, equity value is dependent on capital structure, while EBITDA is not. So you're kind of comparing apples to oranges with that one. And that's why EV over EBITDA would be a much better multiple, and why it's often the most used one. We can roll on to the next one.
So
this is touching on Mia's question earlier. Yeah.
So cost of debt or cost of equity, what's higher? I'm just going to go through this real quick. If you're financing operations with equity versus debt, you have to consider what it's worth for both. Cost of equity is based on CAPM, and CAPM is basically an equation that assumes a risk-free rate, a beta of the company, which is the riskiness of the company, and the market risk premium of the company, some value of the company's performance in the stock market over the risk-free rate. Equity is costly. Equity is not promised in a bankruptcy, in times of conflict, while debt payments are insured by law, and debtors are usually confident that they have some collateral, some systemic means to recover their payments. That's why enterprise value, we add back debt. Those are outstanding obligations that we have to pay. And thus, debt investors require less compensation as there is less risk for them to have their money recovered in the event of trouble. Equity investors, require much more compensation for their level of risk because none of their money is guaranteed in the end. And so what's higher, cost of debt or cost of equity? Cost of equity is almost 100% of the time higher, especially in the climate these days. And it's interesting to note as well, more debt in a company, do you think, I'll ask this real quick. Do you think if a company takes on more debt, their cost of equity will increase or decrease?
Increase because taking on additional debt leads to increased risk, which increases beta, and then cost of equity in the CAPM is higher.
Beautiful. That's exactly right. And I guess the simplification of that is exactly what Pamela said, that cost of equity is going to increase as the company inherently takes on more debt. More debt is the risk that you won't have enough cash or short-term investments to pay down that debt in the midst of a crisis. That's what makes the company riskier and what ultimately raises beta in your CAPM. Beautiful. Thank you, everybody, for staying on. I'm about to link a very, very short Google form. We have, I believe, 6 guides, although they're a little old. They're definitely still relevant because why, Chad?
Because the financial service industry has no innovation whatsoever.
That's exactly right. So we're linking this right now. Let me know if you guys can access this real quick and drop your emails, like a thumbs up or that it's okay when you click on it. Definitely want to reward everybody that has stayed through us this long with the tools that we use to succeed. So any Q&As from everybody, please spit it. Doesn't even have to be about this. Ask us anything. We're open books.
You watching the debate tonight?
What is it, VP debate? I didn't even know it was on.
Pence Harris.
Christ. I low-key might. I actually will now. I have a super day tomorrow, but that'll distract me for enough time. Who you got? You got odds on somebody?
Nah, man. Just
Yeah, I'm hammering Harris if there's odds for a winner tonight. Any other questions?
Last chance, guys, or else I'm going to close out.
Looks like the responses are healthy. Awesome. All right, I'll be able to send you guys probably tomorrow. Following everything that I got to finish up, I'll be able to link everybody these guides. So hopefully they're helpful. Don't give them away to just anybody because they're the secrets of how you get in. Yeah, hope you guys enjoyed it. Get studying. If you're a sophomore who's going to be in some sort of diversity program, you should probably start now. If you're just looking for general recruiting, probably December is a good time to start at the latest. So get on it and good luck, guys.
All right. Thank you so much, Nick and Chad. I'm just going to take, I was going to say the remaining time where we are a little bit over, but just to close out and do a few announcements. Thank you again on behalf of Scholars of Finance for joining us for this skill development session on technical interview basics. Our next event, a panel on ethics in finance, will be happening on October 21st, again at 7 p.m., again on Zoom, and more information on that will be coming for sure to Slack, potentially to your email soon. And to everyone on this call, we want to make our skill development workshops as impactful as possible. And so we'd love your feedback. I just put a survey link in the chat. We would really appreciate it if you take a quick minute to fill it out before hopping off the call. If you do have to go, a link will be emailed to you later, but would appreciate if you do it now. And everyone, again, thank you for coming, and we hope you have a great rest of your week.
Thank you for coming, everyone.
Thank you, guys.